I bet you want to know what I've been up to all week.
I do want to know.
Well, I've spent the last 4 or 5 days building my own Claude bots.
How has that been for
We're
you?
now OpenClaw, by the way. It was Claude bot, then it was Moltbot, and now it's OpenClaw, and I think it's going to stick with OpenClaw. It's been quite a ride. I've had to pull back the few courses I took in computer science in college and put those skills back to work. And I've been having a lot of fun. I've built an AI executive assistant, and her name is Jessica.
Do tell us why her name is Jessica, Christian.
I dated a lot of Jessicas, in serial.
What was the
I just
number
went
you
on a
mentioned?
run where I dated one Jessica, and then I met another Jessica, and another. Like it just kept going, and then after that, I just didn't want to bother date anybody else unless their name was Jessica. This
For
is like a
strict
3 or 4.
convenience.
This is like a 3 or 4 year run. Then I needed to move on.
And it wasn't like you were looking them up on social media and saying, I specifically want to date a Jessica. It just
No,
happened.
there's been a lot of Jessicas in my life.
I'm sure your wife loves that.
She's got some thoughts about it, but
I'm sure. I would love to hear her take on it.
yeah. Anyway,
At another time.
and for another time. Welcome back to the Inorganic Podcast. It's great to have you with Ayala and I. We've got a really interesting episode for you. We've got market happenings, we've got deals, good stuff.
Go for it.
All right, so we're going to hit 2 topics on this episode. Number 1, independent agencies. Silicon Valley has put a target on your back. Your profit, your business plan is Silicon Valley's opportunity. And if you remember in our early January episode, we were talking about the frenzy in the AI era. We might be seeing some AI M&A frenzy hitting the agency market. So we're going to cover those 2 topics on this episode. So why don't we start first and foremost with the hot topic, which is Silicon Valley. So I just have to, I'm going to share this on our screen for those who are watching and our listeners. I'll read it out for you here. Ben Lang posted on Twitter, Y Combinator's 2026 request list for startups. Ben Lang, of course, is at Cursor AI. Number 3 on the list, AI native agencies. Agencies have always been crazy hard to scale. Now, instead of selling software to customers to help them work, you can use the software. You can charge way more by selling them the finished product at 100x the price. Bottom line point, agencies of the future will look more like software companies with margin and scale. Ayala, what do you think?
That's the big one. Agencies will look more like software companies with margin and scale. That's the expectation that's being put on them right now, right? So there is, yes, that is what they will look like, but that is also then, because we have a lot of sellers that listen to us, that is the future expectation for when then they go to sell, right? And so that's a really interesting dilemma that we're going to see. And Christian, I feel like this is a good question for you is like, you have conversations with sellers as well as I do. Like, what are they saying? Like, what are you seeing in terms of the current structure of these agencies or these like tech forward agencies?
It's kind of like a tale of 2 cities, to be honest. Like if you look at the field of agencies that are available for acquisition right now, there's sort of 2 flavors. One is the traditional model of some services and some tech, and we kind of put it together and create that traditional looking agency business. And a lot of the tech is built around managing media or creative. And those agencies are typically operating at 20%-ish EBITDA margins. And they're not terribly differentiated as businesses, so there's not a lot of appetite to acquire them. The other side of that universe, the other city that I've seen a growing number of, but much lower supply of, is very tech forward, very tech-led agencies that follow a typical profile of 40% EBITDA margins, where basically they're producing, call it 10 million in revenue, 4 million in profit. And when you go dig into the business, there's way less people than you would expect in an agency with 10 million in revenue. And so what's happening is there's this new cohort of modern agencies that are just running leaner and using tech, whether it's AI enabled or all the other platforms out there, Bubble.io, things that just make it easier to build software and just doing it leaner, cheaper, easier, but delivering the same outcomes plus for their clients. And so the first group that I talked about is sort of that group that's, just kind of it's everywhere. There's a lot of them. So they're not highly desirable, nor are people really paying up for them if they do go to market. The second group, I think people are willing to pay up for because they represent the modern era. The challenge is that second group, it's kind of hard for the scaled agencies to process because they're like, how do you do this? And is it sustainable if we ingest you into our traditional business that has kind of been doing things the way we've been doing things for a long time?
Not only it's hard for them to process and like potentially integrate based off of the other agencies and companies that they have underneath, their umbrella, but
Yeah.
how do they actually go and place a number on their heads, right? How do you evaluate these companies when it comes to that size and scale, when sponsors and financial partners, investors, acquirers have been used to putting a specific structure dollar on their head? That's the
Well,
really interesting problem for
Well,
me.
yeah. So I think the point you make, we elaborate on it a little bit more here for a moment. If we're thinking about private equity sponsors who have typically invested in the marketing services space have made a bet that services are highly defensible businesses because people will continue to need them. And there's always been more recently conversation about will AI disrupt? Will AI disrupt? No, it'll just create different work streams, lower cost, things like that. What a lot of those investors avoid is investing in software. They haven't traditionally liked SaaS, or they've shied away from SaaS in favor of services oriented business, or at least their themes thematically when they invest. What's happening here is the convergence of the two. And I was having dinner with a founder a couple of nights ago, and he was telling me that investors are actually concerned that pure SaaS businesses are disruptible, and therefore what investors are looking for in early stage companies is the pairing of software and services. So I think what we're seeing from Ben Lang's post here about, the Y Combinator search is, AI led agencies where the services are there, but the tech is really what is driving the margin and the next outcome for the client, along with, the price tag to go along with. I just don't know if the current world sponsors are fully able to process this environment because it's a different financial model.
Well, some will be and some are, but and we'll talk about, recent deals
Yeah.
too, but some aren't because the conversations that I've been having
Hmm.
with sellers that are, operating at really strong margins, tech forward, and like have extreme profitability, the deal structures that they're getting, it's a high multiple that they're receiving, but the structure is absolute crap. And they're almost getting like the cash on close that the guaranteed cash is like almost half of what it should be. They're they're giving them a valuation that's at half of what their like EBITDA is
Mm.
than what, their current reality actually
Well, you
is.
made a very strong statement there saying the deal is crap. The deal is modeled to de-risk a lot of the things that have been inherent in traditional agencies, which is clients that are retainer and or project or large, sort of client concentration. There's a lot of different things that go on inside of agency businesses that sort of make financial sponsors want to create structure to sort of protect from those risks. The interesting thing is that if you bring one of these margin, like outsized margin businesses that are more tech forward to the table, what is the benchmark for valuing and structuring those deals? If you've been doing what you've been doing, you're used to what's been happening in the past, which is where the puck is versus where the puck is going. It's hard to be one of the first to make that bet. But in transitioning this discussion into what I think is probably an example of a sponsor and a platform getting wise and figuring it out, we should talk about the very fresh announcement of New Engine's acquisition of Grapevine AI. Do you know much about New Engine? What do you know about them?
So New Engine is a PE-backed digital marketing agency, manages over $1 billion in ad spend, is obviously doing an M&A roll-up strategy. There's, 450 plus employees, we know that it's between 90 and $100 million in revenue, and they've executed on multiple transactions over the last few years. So, there was Acorn, which was influencer marketing. There was LD Partners, which is partner marketing. Donut Digital, which was in September of 2024, which is creative and performance marketing. And then the most recent is obviously Grapevine. So tell us what you know, because you have an interesting take, because you also were looking at this agency too.
Well, I mean, you kind of had to be. I mean, it was, first of all, Palazzo was the banker on this deal. So congratulations to Palazzo on getting this deal over the line. And we'll talk about Grapevine in a minute. But one thing I wanted to say was Donut Digital was another incredible acquisition. A lot of the scaled agencies looked at that business and were at the table. I'm confident that Holdcos and even Accenture probably looked at it, that when that deal closed, a few people were sort of like, oops, we let that one go. So that was a great deal for them. I don't know if Grapevine falls into the same sort of wow, I missed that one. I think people had a hard time understanding grapevines. Grapevine is it's like a creator agency. They operate a network of about 700 curated creators to produce authentic, creator-led content for paid social campaigns. The key differentiator of the business is their whitelisted distribution model. They create, advertorial style content with creators and then run as paid ads directly from those creator accounts, not from the brand handles, which is kind of a more modern way of doing these things. And the founder, well, the business was founded in 2023. The founder and CEO is Caroline Levere. I did meet her last year while she was running what I think was a very select process with Palazzo. She wasn't just talking to everybody. She was looking for sort of tech forward potential partners. And I think it took a little time for the sponsor universe to sort of figure this business out. One, because it is so tech forward, and two, because it is, 2 or 3 year old business. You're like, hey, will this thing vaporize and disappear overnight? But no, it's really established that this is the kind of stuff you need to be doing around influencer and creator. It's very smart. It's very thoughtful. It's tech forward. It's very AI led. So I think it was a really impressive business. But what I think is more interesting is a little bit about the rumor mill. What hot tea have you heard about this deal?
Well, why don't you tell us the hot tea? Because I feel like you know more than I do on
No,
the
I
hot
don't know
tea.
more than you do. We talk to the same people. I think, like,
Yeah.
look, large upfront cash outlay
Right. Larger
for
than 10x multiple.
yeah, larger than 10x multiple. And I think, look, when you look at a business with 25 to 30 people in this space, you're generally looking at a business that's probably somewhere between 4, 5, 6 million-ish revenue, probably. I would guess with a pretty impressive EBITDA profile. I do know in the back of my head, but I'm just doing the back of numbers math that we would topographically see for these kinds of businesses to be fair and honest with the universe. And so you look at this kind of a business, and a typical scaled independent agency would look at this and say, I'll give you a 7x multiple on this business, and I'll give you some structure and let's see what happens. And I think that this founder probably said no to those offers and pound sand and waited for someone to come along, as New Engine did, and got a little bit more aggressive in their approach, as we've heard. But this is going back to, again, our January podcast where we talked about the M&A frenzy in the AI era. This could be the first land on the moon of the frenzy getting into the agency universe, the sponsor wrapping their head around this business model, which is different than what most scaled agencies are looking for in potential acquirees. We should talk about some of the topography of these businesses in general that is harder for them to kind of process, and pulling yourself forward by investing in this tech.
Yeah, I think it's going to be really interesting to see as this quarter moves forward and the activity that we're seeing, because I think that there's a lot happening right now and a lot in mid process that it'll start to hit. What's going
Yeah.
to be interesting to know, and this isn't usually what's disclosed, is what the structure is, right? Structure
Yeah.
is the new EV. I
Yeah.
don't I don't give, a damn about, a 15x if your cash is going to be, 5% of the deal. It's really, going to come down to what's going to be public knowledge around what are the structure of these companies. Are these
Yeah.
sponsors willing to actually put up the cash? How are they putting the valuation on these on these companies and, defending them too to the sponsors. And what is the rationale behind the deal? And
That was a lot. Let me ask
yeah,
you this
sorry,
question.
there was a bunch in there.
You talked you talked to a lot of tech forward sellers, and there is a bit of a rub between like the things what the buyer is willing to pay and what the buyer is willing to structure and what those sellers want. Like what are you seeing?
So traditionally, we've been used to in the services sector, we've been used to a significant for a scaled agency, a significant amount of cash on close. Then, at the end of the day, there is the contingency payment, there is some type of
Mhm.
earnout, and then there's rollover, right? And the earnout was created to bridge the gap between what the seller thinks that they deserve and what the buyer wants to pay for it. And it's like, okay,
Yeah.
well, then I'll bridge this with the earnout because if
Mhm.
if you, make this amount of revenue that you think you're going to make or profit margins you think you're going to make, great, no problem paying you. Seller's happy, then buyer's happy. And we've traditionally seen that a lot of companies don't necessarily receive their full earnout at the end of the day for various reasons that we won't get into.
Yeah.
But now there is this conversation happening of sellers are saying they have a very high margin business. Therefore, I deserve to be treated with what we would see as a traditional deal structure with 60 to 70% cash on close, maybe 20% rollover, 10% earnout, or something along those lines,
Yeah.
right? And that's not the conversation that buyers are having right now. They're saying we're going to let you roll over a significant amount. And the rollover is almost replacing what the earnout would be because they just don't know what to do with it. And that's the justification they're having to
Mm.
their sponsors.
I think if you're a scaled independent, and I've worn the hat, you do want acquired founders to one get you want to give them a second bite of the apple, so you do want them to take some rolled equity in the company, but you also want them to believe in the combination, and showing belief in the combination is taking some of that role. But the traditional structure of 50, 60-ish percent of upfront and the balance being a combination of contingent and role, I think these tech-led founders are getting wise to how Silicon Valley does the deals and saying, I want to see my tech-led agency, I want to see more of that M&A model. I want to see less of this traditional M&A model. So, like I said, it's like this is probably one of the first landing on the moon. I know that last year Accenture acquired Super Digital. That deal was run by Everose, and I think the back channel was close to a 10x multiple on that business as well. With almost, I think it was all cash. There was no contingent consideration. So maybe this is number two, but I think we're getting the beginnings of this pattern of what does it look like. And so if you're a sponsor backed platform, you have to start asking yourself, like, is there a way that we can come to the table and play with this shift in the market? Or do we have to figure out organically how to meet the market where it is? And they have most of the scaled independent agencies have the Clayton Christensen innovators dilemma, which is most of those businesses build and do things based on where the puck has been versus where the puck is going. And it's really hard to shift the business and the people and the clients as well. I mean, a lot of the clients are part of the problem sometimes because they're like, we like the old way of doing things. Why are you trying to modernize us?
I mean, you see that in like the operations of these businesses when they're coming to the table with contracts that are saying you can't even use AI
Yeah,
in these projects, but then
yeah.
it's like you really dig into it and it's like, okay, well, where can you, where can't you? And it's like, but you're starting with that, like people don't want to change, people don't love change. That is human nature, right? And so who is going to jump on this bandwagon and who is going to make the bet and will it pay off is the real question. So, right? You don't want to be, just betting to bet. I mean, I think back to when NFTs, right? When NFTs came on the scene and everyone's like, I'm making the bet, I'm doing this. And like, where is that today?
Yeah. Well, if you go back, it's always about the thesis, the strategic rationale. And I think the thesis is brands are increasingly finding that ads run from creator accounts. There was one of the companies out there has a really great pitch, says consumers love to ignore ads. So how do you get them to pay attention? Creators are a great way to do that. Hello, we're creators. And so the strategic rationale here is that this fills a gap. And I think this is an up level for Donut. They probably are going to put Grapevine and Donut sort of together and make this kind of a part of the packaged offering, putting those two pieces together. So it'll be interesting to see how that comes out into market as this evolves. But I think it's an exciting moment. It's a great acquisition for the early part of the year, and we're
I
gonna
like
keep.
this deal. I like this
Yeah.
company. I am just so curious to see how the other sponsors react to this and what they're going to do in the next 6 months. Jump on the train.
Do they all? Do they at all? I don't know if they will. We'll have to see. I
I
mean,
don't know. I mean, I have multiple deals in process right now, so we'll
hey,
find
hey,
out.
teeth, come on.
We'll see.
All right. Well, look, good conversation. Silicon Valley coming after independence and an example of AI led tech and a picking up steam in the agency market. If you liked this conversation, if you enjoyed what you heard today, please share it with your friends, like, subscribe, all of those great things. Ayel and I really appreciate you joining us for this episode of the Inorganic Podcast. Right, Ayel?
Absolutely.
Yeah, there you go. All right, we'll see you on the next episode of the Inorganic Podcast. Take care, y'all.